In today's video, we'll talk about Real Estate Investment Trust, which is also known as REIT. The topics which we will cover in this video are: what is exactly REIT? How does the REIT work? What are the SEBI regulations which are important from the investor's point of view? What is the taxation in the hands of the unit holders? What are the performance indicators or the selection criteria which the investors should consider at the time of investment in REITs? And finally, what are the 4 REITs in India which are listed on the stock exchange? What is a REIT? Real Estate Investment Trust is a company that owns and operates real estate properties to generate income. The properties can be in the form of large IT offices, hospitals, malls, and other commercial property. Now let us understand how does a REIT work. There are investors who want to make investment in the real estate investment trust. Now they will buy units of real estate investment trust. Now real estate investment trust invests money or buys commercial property in various cities in India. Now these commercial properties are given on rent. So the rent income which is received from the commercial properties by the REIT is distributed to the investors by way of dividend. So it is similar to the working of the mutual funds. The investor buys units of the mutual fund invests the money in shares or debt instruments, and the mutual fund pays dividend to the investors. So the REIT working is similar to the working of the mutual fund. Now let us see SEBI regulations which are important from the point of view of unit holders. 90% of the net distributable cash flow of the REIT has to be distributed to the unit holders. This has to be done twice in a year. Now in India we have got 4 REITs which are listed, which distribute cash flows 4 times a year, that is once in a quarter. 80% of the value of REIT assets shall be completed and income generating assets. That is, they are earning rental income, and only 20% can be invested in assets under construction. 50% of the directors on the board of directors of REIT should be independent directors. That means they are not managing the day-to-day affairs. They independently view the REIT and give their opinion on the major matters which are discussed in the board meeting. REIT cannot take a loan more than 49% of their total asset value. If REIT takes a loan above 25%, it has to take an approval of the unit holders. Valuation of assets should be done twice a year. The valuation has to be done to find out the current value of all the properties which are owned by the REIT. Annual report should be submitted twice a year, that is half yearly report and annual report. Now generally the listed companies submit annual report, that is once a year, and that is why it is called annual. However, in case of REIT, it has to submit 2 reports. One is a half yearly report up to September and one is an annual report up to March. Now let us see taxation from the point of view of unit holders or the investors. The income received by unit holders from REIT is of the following types: dividend, interest, capital gains, and other income. Now whenever a REIT distributes cash flows to the investor, it generally gives the breakup of these components. That is, how much is the dividend, how much is the interest, what is the capital gains, and what is the breakup of other income. Now dividend is tax-free in the hands of the unit holders in most of the cases. However, if the REIT applies for a lower tax regime, then dividend is taxed as per the tax slabs. Interest is also taxable as per the tax slabs. In the case of sale of units of REIT, capital gains arises. If the units are held for less than 36 months, then it is a short-term capital gains and tax rate is 15%. If the units are held for more than 36 months, then it is a long-term capital gain and tax rate is 10%. An exemption of rupees 1 lakh is also available in the case of long-term capital gains. Other income is also taxable as per the tax slabs. Now let us see the performance indicators or selection criteria which you should consider at the time of investment in REIT. Now funds from operations should increase every year. Funds from operations is rent minus the expenses of the REIT. Second factor to consider is dividend yield, which is dividend per share upon market price per share into 100. Third important factor to consider is the occupancy rate. If the occupancy rate is more than 80%, it is considered as good. It means that 80% of the assets of the REIT are income generating assets. Fourth point is geographical diversification and industry diversification. Now, geographical diversification means that the REIT assets should be in major cities in India, and industry diversification will mean investment or the tenants of the REIT should be from various sectors like IT sector, financial sector, telecom, retail, healthcare, e-commerce, etc. Now the type of assets and quality of tenants. Generally the blue chip and MNC tenants pay rent on time and reduce the default risk. Now weighted average lease expiry. This is, if it is higher, it is better. Now weighted average lease expiry is the way of measuring the average period in which all leases in a property or portfolio will expire. So a weighted average lease expiry of 5 years indicates a stable tenant base and high satisfaction. Debts and loans of the REIT should be less, so lower the better. Now let us see the performance of 4 REITs in India. Now this I have given for the financial year 23-24 on a consolidated basis. You can pause the video and see the different REITs, what are the occupancy rates, what is the WALE, what is the debt equity ratio, what is the total area. This is millions in square feet which is owned by the REITs. Then what is the net operating margin, what is the net profit, and what is the dividend yield. I suggest you pause the video and see, have a look at this. These are all the current figures for the financial year 23-24. Thank you. If you like the video, please click on the like button and subscribe to my YouTube channel.